Hello everyone, Dividend Enjoyer here, and today I'm going to be doing my weekly update on my $24,938.07 portfolio. Currently in the Chase account, I'm down $819.64 in unrealized gains or losses, with an estimated annual income of $484.45. The value of the Chase account is also at $16,789.19. I kind of want to jump around a little bit this week and talk about what position I've beefed up a little bit. I have not sold anything. I don't really want to sell any of my stocks, even if I'm up on them. I want to hold these stocks for a very long time horizon. And I really like dips that have been happening in the market recently because I can get better prices on the companies that I want to own for a very extended period of time. And the company that I've added a lot more to has been American Express, ticker symbol AXP. You can see that I'm down 4.62% on it. I think that this business is an amazing one. It's come back a little bit from when I was buying some more of it because it was down, I believe, in the 250s when I initially made another stock analysis video to give myself kind of a better perspective on what I think it's worth. I think I'm going to continue buying this company, especially if it stays below 275, just because I think you're getting a really good price for the type of business that it is. And I'm going to hold this thing for years and years and years because American Express has a proven track record of improving their revenue over time and making more money. And it seems relatively a lot more risk-free than some of the other companies that I do own. And I really like having very risk-free, safe, strong companies, especially when they're on discount. And when they're on discount, those are the best times to be an investor. People are constantly going to be, having news stories or having YouTube videos when the market's falling about how stocks are so terrible, it's a terrible investment. But that's actually the best time to buy into stocks because you're getting more for your money. And if you're holding for the long term, like you're, buying a local business or doing something like that where you're holding the entire thing and it's making you money, then it makes more sense to buy it when it's cheaper than to buy it when it's more expensive and everyone else is buying into it. So now that I've kind of talked about American Express, I think I'm going to go from my smallest position up to my largest position, excluding American Express because I feel like I've already covered it, and just kind of give my 2 cents on what I'm doing with each individual company. Next up, we have Texas Roadhouse Inc., ticker symbol TXRH. I'm currently up 0.36% on this, so it's pretty much flat. It is going to pay me a dividend of, I believe, around 68 cents. Overall, I think that this company is great because it's not like a lot of other fast food or chain restaurants, because I think that there's still a lot of room for them to open up new businesses. And if you're not aware, when you're buying a fast food or chain restaurant stock, you're actually buying the franchising rights along with the restaurants that the actual company owns instead of franchisees own. So really, when you're buying those types of companies, you're hoping that they still have a lot more restaurants that they can open up, or they're able to charge more money for their food, or able to do smarter things with their money, or it's just flat out undervalued for the amount of revenue that they're generating. I'm of the opinion that Texas Roadhouse is going to be able to continue to grow in terms of making new restaurants. And I think that they're a very efficient type of chain and a very just strong company that I think has a lot of growth going forward. And this is really one of the only restaurants that I've looked at and decided to commit money to. In the past, during COVID, I bought ticker symbol QSR, which is Restaurant Brands International. And the thesis behind that was when COVID happened, I thought that the big restaurants, like the chain type of restaurants, your McDonald's, your QSR, which I bought into because it was at a lower PE multiple, my thesis there was that COVID was going to completely kill the mom and pop diners and small restaurants that didn't have the lobbying power, and that in the long term, those brands would survive longer and thrive better because they'd gain more market share. But with Texas Roadhouse, I have the opinion that this particular company is going to be able to grow a lot more than most of its other competition, and that it's going to be able to increase that market cap in the long term. And eventually it's going to turn into something like a McDonald's or like a Wendy's, like a Restaurant Brands International, Pepsi, Coke, all these types of very mature companies. And it's really going to get to the point where it's just generating pretty much the same amount of money every quarter, and it's paying me a pretty good dividend. And that's why I'm holding it, because I think that the long term is going to be very good. I think it still has a lot of growth in it, and I think that it's going to look very cheap going into the future. Next up, I have Prologis Inc., ticker symbol PLD. I believe I added another $100 to this position. I'm currently down 0.47%. I have $700.52 invested, and this is also going to pay a really high dividend pretty soon. I believe it's over $1 that this pays a quarter in dividends, and the share price is $110.45. So it's a very good company. Because they have triple net leases, which means that they don't pay any of the property expenses for the properties that they lease out, and they lease out logistics warehouses. And this just makes total sense to me on their growth prospects. It seems very simple. They collect the rent, they pay me a very high dividend, and then the money that's left over either gets spent to pay off debts or buy more warehouses. Or if someone approaches them wanting to buy one of their warehouses that they have built in the past and now it's worth more, they can sell out of that and get a pretty good gain on that money. So I think Prologis is really a no-brainer, and as we get AI and we develop more advanced logistical networks, I think that warehouse real estate is going to be more valuable going forward, especially as production continues to improve. Like we've seen just overall, GDP grows a lot more when there's new technology introduced into the equation. And I think AI is finally going to be the new technology that helps the broader market. And specifically, warehouse real estate is going to be one of the sectors that benefits greatly. I have bought an extra $100 worth of this because I really think that it is a strong business. And I think it's a very straightforward business. I've done some stock analysis videos on this business, and I think that the share price should be around 120, around there. So getting in at 110 is a pretty good value play, and you're making a pretty good dividend on top of that. I'm reinvesting all of the dividends in this portfolio, so I love the idea of getting a big snowball from buying into Prologis and just holding it forever until I get to the point where my annual dividend income is pretty significant and I'm able to just collect the cash and make investments into specific companies that pay me more cash or just pay my bills with that money. And next up, we have Meta. Obviously, everyone knows what Meta does. I'm down 6.34% on this. I haven't actually added any more Meta to my own portfolio, just because I think elements of it are a little bit riskier than Amazon, which I'm also holding. But I do think that they have a very strong monopoly on social media just in general. And analyzing the cash flows, it's kind of baffling because you would think that there'd be a really high premium on this company for what it is, but there really isn't. And it's just very shocking with the amount of money that they're making and the price that this stock trades for. You would think that the valuation would be a lot higher, and I don't really understand fully why it's selling as cheap as it is. I have this stock valued around $700, but I haven't added more just simply because there may be some new transformation in social media that takes market share from them. But I do think that, like I talked about with AI previously, I think that there's going to be specific AI that Meta makes or benefits from that's going to be able to sell advertisements at a way higher rate. I also think that they have the best data training set out of any company on earth. They have so many posts from so many different people on so many different platforms. And the AI that they're going to be able to develop is going to have some of the best data sets out of pretty much any AI that exists right now. So I think that Meta has a lot of really interesting advantages to it. And the cash flows make it look very cheap for really what you're getting in a very, very strong, robust business that I want to hold for the long term, because I don't think anyone can make social media as good and at the same level as Meta. Moving on, we have Waste Management, ticker symbol WM. I'm up 10.04% on this. It's worth $1,375.79. And I love this business. I don't plan on selling out of any of it, even though the valuation has gone up, but I'm also not adding any at this valuation, simply because I think that a lot of the other stocks in this portfolio have really gone on sale in a lot of ways, and this one hasn't gone on sale in the same ways. And you could kind of see that. The reason that you also want defensive stocks like Waste Management is that they're not going to be affected by strong economic downturns or insane volatility that we're seeing now with the tariff talk and everything else. And I think that part of why Waste Management has gone up so much, and it's a stock that has the highest positive percentage change year to date and just overall in the Chase account, is that a lot of investors are kind of waiting out this period of uncertainty and they're loading into the safest stocks that they can think of. That's all anecdotal, but I believe it to be true because they want a certain return on their money. They don't want to risk anything. They just want to get that guaranteed amount of revenue and growth that Waste Management provides. And for that reason, I'm not buying any more of it, even though I think it's maybe the strongest business in my portfolio, simply because I can't think of any way that Waste Management could be replaced. I mean, obviously, the landfills are very valuable. The fact that you're getting consistent returns despite what the economy is doing is very beneficial for a portfolio. And it just keeps increasing the amount of revenue that they're getting every single year. And they're acquiring new waste companies so that they can increase their cash flows, increase their revenue, and overall it pays a pretty decent dividend. They increase the dividend very consistently, and it's just a very strong company. But again, it's not going on sale, and I like companies that everyone else is afraid to buy into, but my valuation metrics tell me that they're going greatly on sale. And that's kind of why I bought into American Express instead of Waste Management, because I would rather go through the days where there's a red number on my screen so that in the future it'll grow far more, because I got in at a price that was just ridiculously cheap when you're looking back on it. And now, again, we've talked about American Express already, so I won't go over it again, but I really can't stress enough how much I think this is a very safe, good play. Kind of like the next stock that I'm going to be talking about, Amazon. Ticker symbol AMZN. I have added more Amazon to this portfolio. Currently, I'm down 12.4%, and the current value is 1927.2. I have 10 shares. I can't say enough good things about Amazon, and I don't really understand why this stock in particular is so oversold. Almost everyone I have met in my adult life has an Amazon.com subscription. Obviously, Amazon has the cash cow business of their logistical network, delivering packages, collecting money from merchants that want to sell on Amazon. They have the streaming. And what I really love about Amazon the most, and I think they do the best job out of any company in the S&P and in the world at, is that when they have profits, they invest into things that can lead to higher amounts of growth. And you don't really see that out of Apple, which in my last stock analysis video, I really criticized Apple about. Amazon is just very, very strategic and smart, and they understand what they're doing, and they have very long-term plans. So as an investor that also looks at the very long term, I don't think that Amazon is going to be a loser. I think that they're going to continue to gain market share in the different spaces that they operate in. I think AWS is the future. Everything's being built on AWS. And this is probably another stock that I'd like to add more into going forward, just because it's so consistent and there's so much safety in the fact that the cash cow business of delivering the packages allows them to take a lot of risks. And a lot of those risks don't pan out, but when they do, they lead to a lot of future growth. And I think that this is just an amazing long-term business to be able to be an owner of. Now, I also want to talk about Energy Transfer. I own more of this in the Webull account, so maybe I should have waited to talk about it then, but I'll just talk about it now. I'm down 4.7% on it. The current value is $1,627.34. This pays an amazing dividend, and I've talked about this company at length. It's probably the company I've made the most money on. Well, I've definitely made the most money on this company out of any company that I own. For people who don't know what Energy Transfer does, they own the pipeline infrastructure for transporting natural gas, and they charge a toll on that. So as long as there's a higher demand for natural gas consumption in the United States and Canada, this company is going to greatly benefit from that. And I believe that over time, we're going to see energy consumption just increase and increase and increase, especially with the AI data centers that are being built, also with new infrastructure that's routinely being built. I think that this company is going to do great, and it has done great. There was, however, the time when they did suspend the dividend during COVID-19. That was because there obviously wasn't as much demand for natural gas just in general. So I think that this company is long-term just a great buy because you're also getting kind of inflation-proof assets with the pipelines, because whatever you pay for them 5 years ago is the same amount that you're paying off 5 years later. And this company is just been amazing for me personally. I've made a lot of money off of this company, and I really enjoy it. I think it's a great company. It pays a great dividend. You're not getting the same kind of growth that you necessarily would be getting from some of the tech companies, or even Texas Roadhouse, I think, has a lot more growth in it. But I think that this is a very solid company that isn't as dependent on oil prices as some of the oil producers. So if you want a company that is going to benefit greatly from energy demand, and is very difficult to compete with, very hard to get into, I think that Energy Transfer is a great company for that. Now, next up, we have Salesforce, ticker symbol CRM. I'm now down 14.93% on this company. The current value of my shares is $2,703.46. I think that Salesforce is an amazing business with great long-term prospects. I think expectations are a little bit high on Salesforce, and that's why it's been so oversold. And people are really just scared to get into tech now because, again, tech has been just completely sold out of. I think that this company is going to continue to increase the amount of revenue that they make, and you can see that from their historical amount of revenue that they've made. This company offers amazing products. They continually improve those products, and they're focused on just the one thing of customer relationship management software. And when companies like this that are historically amazing and they continue to make more and more money, I think that, Salesforce in particular, I think could be on the same level as a Microsoft, as an Apple into the future. But when those companies go on sale like this, I think that's the best time to buy in, when everyone's afraid to buy these companies and everyone just seems to have too much fear about Salesforce, and I believe it's an amazing business. That's the time to get in. And I've talked about this a lot in the past in pretty much all of my portfolio review videos, but they benefit greatly from network effects because as people are using their software, if you don't know, it's very difficult to get out of once you're in. So they kind of not trap the businesses because it's mutually beneficial, because these businesses are getting a better software for cheaper than it would cost them to develop themselves. And they deal with everything related to customer relations. But as they enter that Salesforce software, they're not really able to leave, and Salesforce is making money off of them. And with that money, Salesforce very intelligently improves the software so that more businesses can come onto the Salesforce software in general. And as these other businesses that are on the Salesforce software grow, Salesforce is able to charge more and they're making more money, so they're both happy. So they're benefiting from that as the businesses that are using them are able to grow, they're able to pay them more money. And new businesses are constantly coming into the Salesforce ecosystem using specific products or integrating their entire business into Salesforce. And that's great for the stock. And I think that that's going to continue to be a trend over time, and that this software is extremely valuable. And it is definitely undervalued right now, in my personal non-financial advice opinion. And I've been buying more. They also just increased the dividend 4%. It's not really a dividend that you can write home about, but I love when companies increase their dividends every single year consistently, and I think that Salesforce is going to do that. The dividend's relatively new, and it's not something I'm like insanely excited about necessarily, because it doesn't represent nearly the amount of cash flow or the price for each individual stock that some of the other companies on this list give. But it's still good. I mean, I'm glad to get a dividend, and you can tell by the name of my channel that I enjoy it. And moving on to the number one stock in the Chase portfolio, we have Vici, ticker symbol Vici. I'm currently up 0.77% on this stock. I've put about $5,000 in there. I know it says 5,063.32, but that's including the last dividend payment I got. And this is going to pay me a dividend payment of just above $65 for this quarter. Great dividend yield on this stock overall, and I don't think I'm going to add any more just because I can say that I have just 5,000 in. But talking about the business, they are the biggest owner of property on the Las Vegas Strip, and very similar to Prologis, these are all triple net leases. So they own a lot of the casinos that you know about, whether that's pretty much all of the MGM properties, Venetian, Excalibur, a lot of different Las Vegas properties on the Strip that I think are very difficult to value because it would be impossible to build these properties on their own. But they do not own the actual rights to run the casino. They just own the actual physical buildings, and then the casinos pay them rent. So this means that they have very, very rich people renting their properties, very big corporations, and it's very unlikely that the casinos are going to not have enough money to pay their rent every single month or quarter, or however they have their agreement set up. So it's very consistent revenue, and just like Prologis, they're able to pay a very high dividend, like you can see. It's around 6%, I believe, and that's just off the top of my head. But a very high dividend for your cost on a yearly basis. And then with those retained earnings, they're buying bigger properties that generate more revenue, and then they're able to increase the dividend over time. And so I basically am seeing this as I put my $5,000 in, and in enough time, it's going to keep reinvesting and buying me more shares with the dividend, which those shares are going to pay me a higher dividend in the future. And eventually, this $5,000 Vici investment is going to pay a considerable amount of money to me in the form of a cash dividend that I'm going to be very happy to just sit back and collect, knowing that it's a very safe real estate company that buys good experiential real estate that makes a lot of money with very low risk relative to a lot of other real estate investment trusts. And, I really wish, because I was making a lot of videos on this stock when the company was below $30 a share, because I believe the fair value is somewhere around $34 to $36. So I still do think that Vici is undervalued, but I think a lot of these other stocks are a better value for what you're getting. But I made a lot of videos talking about Vici when it was below $30, when it was around $28.50. And, they didn't get a lot of traction, but I really wish that from those videos and from that analysis, I would have put like $10,000 into this stock, because I knew that it was very safe and I knew that it was what I wanted to own. And I just really regret not putting more money into this one stock that I knew was a surefire thing, but I still think I'm going to walk out doing pretty well for myself from this company and from this investment. Now, moving on to the Webull account. This is an account that I have the money sitting here, and I just sit back and collect the dividends. I don't add anything to this account. It is simply there from profits from when I was trading before. I've made all of the money back on all of these stocks and just kept these ones in here so that I can just collect the money and either put it in the Chase account or keep it in my personal checking account. I have 328 shares of Energy Transfer valued at $6,107.36, and they're up 59.17% on an unrealized basis. This doesn't include anything I've sold out of or the dividends it generates me. That pays me about $106.60 a quarter, which I'm very happy to just collect and put in my checking account or reinvest into Energy Transfer shares on the Chase account. I also have some DraftKings stock. I used to sell options contracts, and this was half of the profit from doing that. So I would have enough cash to buy 100 shares of DraftKings at a specific price, and I would offer to buy the 100 shares at that price and get premium up front for that. And then if I got assigned, I would offer to sell calls at a higher price than what I offered to buy the 100 shares at. So it was decently risky, and it's something that, had to take a little bit of time to kind of monitor and make sure I didn't lose the entire $4,000 or whatever it was, right? So I just have these shares there because I think DraftKings is very insanely risky, but it's also very high growth, and I think that this could be an insane growth stock going forward into the future, but I don't want to commit a lot of money into it because, again, there is a lot of risk, whether that's regulatory or just financial or a number of different things that could happen in that industry. But I do want a little tiny bit of exposure to it just because I've already profited off of it. So this is kind of half the profits. And then I have 5 shares of Microsoft that pay about $5 a quarter, something around that. I'm down 10.58% on this, but I've talked at length about some of the companies that I think are amazing companies, and I think Microsoft is one of them. I'm not going to add or sell any Microsoft just because I think it's very similar to Amazon, and I just like Amazon more fundamentally as a company. I think that Microsoft is a little bit more mature in their approach, and I think that Amazon is doing a lot of the things that I'm seeing better than how Microsoft is doing it. But I still want to have some exposure to Microsoft just because I do think it is a very strong competitor and a very amazing company, and I'm just going to hold these shares for the long term and just collect the dividend. And this would be the account that if I needed money, I could sell these shares out because I don't care about it nearly as much as I care about the Chase account. That's kind of my portfolio review. Let me know what you guys think down in the comments section below. Please leave a like. Please hit the subscribe button. It helps me out a ton. I've been reading all of the really nice messages, and I just want to say I really appreciate it. Thank you so much. Have a great day. Bye.